I think we'll get started. Yeah. So hello all, and thank you for joining us today. I am Ryan Anderson. I'm the outreach manager here for Kendal at Home, and I'm pleased to welcome you all for our seminar on tax planning, investment strategies, especially around this fourth quarter, around this end of year time, where we're all trying to make sure that we're all set up for the best spot for this end of year, and also helping us to set up for 2022 upcoming. So with us today, I have Sue Woykin, who is the marketing and events coordinator with us at Kendal at Home, and she'll be handling all the behind the scenes stuff, any technical issues there, Sue. Any technical issues that you might have, please feel free to message those in the chat. She'll also monitor the chat and the Q&A for any questions that you might have that arise during our presentation. So if you have any of those, please feel free to put those in the chat or Q&A, and the questions we'll get to at the end. With us also today is Lindsay Scott, who is hi Lindsay. She is the regional sales manager for the Northern Ohio region. So a lot of you, if you are current members or prospects in this Northern Ohio region, you might know Lindsay very, very well. So she's with us today to help answer any questions as well. And with us today is our main guest here, Brad Noren. So Brad is the Director of Endowment Solutions at Winfield Associates here in Cleveland. He has 20 years of institutional investment experience, with 14 as an equity research analyst at Victory Capital Management. And he's also a graduate of Bucknell University and Georgetown University. And so he also has the CFA charter holder and a CPA, which isn't active right now, but it serves as a trustee and investment committee chair on the Stocker Foundation. So Brad, we are very pleased to have you today. Thank you so much for taking the time out of your day to give this presentation, and looking forward to hearing what you have to say about end of year 2021 and looking ahead to 2022 and beyond.
Hey, thank you, Ryan, for the introduction. And it's also important to note that Ryan's a Georgetown graduate as well. We did not overlap, but we're both proud alumni. So tax proposals, what we're going to talk about is, year-end tax and investment planning. First, we'll touch on, the current bills that are trying to be passed in Congress and what that means for taxes. Specific tax considerations to the listeners today is around, managing your income and your deductible expenses as we approach year-end, as well as what types of investment accounts to withdraw from during the retirement years, which is a longer term perspective. And if we have time, we'll kind of touch base on the current investment environment and our outlook there. What we do at Winfield is, we help our clients achieve their financial goals. Importantly, we try to do this tax efficiently, especially with the prospects of taxes going up near term. Now, before I get started, I wanted to share a little story with you. I wasn't quite sure what to talk about today without putting everyone to sleep. So, I went to Google and I put in the search box, how to make a tax talk interesting. Well, there weren't any good answers. Talking about taxes is dull, it's boring. No one wants to look at charts or tax tables. So what people do want to talk about is how taxes affect them, and that's most important. The main questions people want answered is obviously how much do I owe at tax time, but also how can I lower my taxes, and how can I deal as little as possible with anything related to tax. So my approach is to talk as little as possible about the tax rules, which we don't even know yet, and to talk mostly about the benefits of tax planning and management. Just to let you know, I work at Winfield Associates. Besides being in charge of our institutional clients with endowments and foundations, we also work with a lot of families and individuals. And we are SEC regulated, so I have to give our disclaimer that, today's call is for discussion purposes only. I'm not providing tax, accounting, or legal advice. Listeners should contact their own advisors as to any statements that I make here today. The reason for that is everyone on this call has a unique financial situation. So, it's best to discuss these topics with your advisor accountant. If you would like follow up with me, please reach out to me through my contact information. On to we can move to the next slide, Ryan. Thank you. Yeah, what is going on in Washington today? The government is trying to pass two big spending bills. This is the most spending since the New Deal back in 1993. Or I'm sorry, 1933 under Franklin D. Roosevelt. This is comprised of the American Job Plan, which is the infrastructure bill, which looks like it will be passed. It seems like some people in Congress want to pass both bills at the same time. Now, this infrastructure bill, it's for 5 years, $1.2 trillion, and it will be funded by corporate income tax. The American Families Plan, which is the one under debate now, started off as a wish list of 3.5 trillion. That would be funded over 10 years, primarily through individual income taxes. And it looks like, at the end of the day, this will be passed, but ideally it'll be more like 1.5 trillion to 1.8 trillion. Let's say it's a pretty ambitious spending plan. Some of the things are definitely needed. I'm not sure if there's a lot of debate about everything that's in that current package right now. So the infrastructure will be corporate taxes. The American Family Plans will be a combination of ordinary income taxes, capital gains taxes, and estate tax changes as well. The next slide, please. Just kind of looking back at the past 60 some years of taxes, we are in a golden age of taxes. The tax cuts back in 2003 took both capital gains and dividends down to 20%, which is pretty much the lowest on record. Some of you may recall when dividends were taxed at 60, 70, 80%. In 2013, taxes on capital gains and dividends increased a bit, 3.8% through the Medicare surcharge. The tax changes that were made in 2017 did not impact capital gains and dividends. That was more lowering corporate taxes and ordinary income on employment. So now today, taxes are going up, and that's kind of the punchline. So how can we, manage this as best as we can? And then going to the next slide. This pretty much looks at the the president's desire to tax high net worth people. It's more a wealth tax as opposed to a tax on employment income. These things go in cycles. So, but after last almost 18 years of low taxes, that it's natural and normal for taxes to be increased. Specifically, I don't want to get into the charts in that, but it looks like the taxes will be focused on individuals making over $400,000 or couples making over $450,000, as well as a wealth tax on accumulated assets. And this will be accomplished through increasing ordinary income back to 39.6% from 37% for high income earners. The tax on capital gains, it will be raised about 5%. When you add on the Medicare surcharge, it'll probably be 28.9% tax. the estate tax exemption, which were essentially doubled back in 2017 up to 11.7 million per individual, about 22, 23 million per couple. That, if nothing would change, that would sunset after 10 years, 2026. But there is discussion about that being reverted back to probably around $6 million, being cut in half. And these numbers are adjusted for inflation. So we'll see if that passes. There was some talk, more so in the media, I believe, than actually would be possible, would be eliminating the step up in cost basis for inherited assets. Very unpopular. As you all know, estates that are above the exemptions are taxed. So not allowing a step up in basis is essentially a double taxation in my mind. So that's kind of it for, tax changes. And these are some of the things that should be talked about. The listener here, your challenge really is to not outlive your financial assets. You need to protect your assets. You want to grow and maintain your income. You need to support your after-tax spending. And, it's pretty timely to be on the call with Kendal at home, because the biggest unknown variable over the next, few years is going to be your healthcare expenses. And there's a saying, if you have your health, you have your wealth. Well, everyone on this call recognizes the uncertainty around healthcare. And it's, I commend you for taking steps to try to manage this unknown future expense with Kendal at home as a resource. That is, smart planning on your part. Some of the things that, as an investment advisor, we encourage our clients to talk to their accountant with is about, and this all depends upon your lifestyle stage. My understanding is people on this call most likely range from, age 60 up to 80s, possibly 90s. So this is really should be looked at as kind of what your life stage is. Now, the first one is whether you are still working or not, or started receiving Social Security or not, you can still pursue a Roth conversion. And I'll talk in more detail about that. Now, if you're still working or have full-time or part-time employment income, you're able to contribute to a retirement account. With that, you can decide between, 401k, if your employer offers that, a traditional IRA account, or a Roth account, depending upon your income levels. And if you are fully retired and are in the withdrawal stage of life and your assets, we'll take a look at which kind of buckets of funds to withdraw and pay for your expenses in a tax efficient manner. Now this next slide discusses a Roth IRA. I expect everyone here knows what a Roth IRA is, but they're very advantageous because when you contribute to them, you're paying your taxes up front, and with a low tax rate environment that we currently have, you're able to take advantage of that and reduce uncertainty around future tax rates. Now, there's a chance future rates could be lower. They may be lower depending upon each individual's circumstance around their sources of income later in life. But it's the biggest benefit of this is that when you withdraw money from your Roth IRA, it's not taxed, and that has a lot of benefits that we'll talk about. Also, just touch base on some of these items. Roths are not subject to required minimum distributions on traditional IRAs, and those required minimum distributions kick in at age 72 now. And if you do, do a Roth conversion, which I think we go to the next slide, you are able to, a Roth conversion is where you would convert from a traditional IRA to a Roth. So you would take your traditional tax deferred account, pay current taxes on that, and then move it into a Roth IRA, and then not be taxed on future withdrawals. And you are able to do that. You don't have to do, it's not an all or nothing. Depending upon marginal tax rates, when speaking with your accountant, it may make sense to do partials. We have clients that may do, $10,000 to $20,000 a year. There's kind of a sweet spot to do this, and that tends to be once you're retired and before you're taking Social Security, and that in age, that tends to be age, it's about 62, 63, or 65, all the way up to about 71. It's advantageous to do it when you're either retired or have low employment income. If possible, it's important to delay Social Security as long as you can. You all probably know more about that than myself, but my understanding is, if you delay Social Security until 72, your life expectancy break even is around 83 years. So depending upon your health situation, whatnot, we tend to work with people using assumptions that people live to their early 90s. So it's best to delay it if possible. Another way to kind of reduce your income that may make a Roth conversion more attractive is through your deductions, charitable giving, medical expenses. I know Kendal at home, a lot of those expenses can be considered deductible for on your taxes. And also, last thing is if the market experiences a downdraft. Me personally, back in 2008, 2009, during the downdraft then, I moved some assets from a traditional IRA into a Roth IRA. Really, it's based upon individuals. Last year was so interesting with the COVID and all the government programs. I think people's income were all over the board. We had some clients do Roth conversions from a traditional into a Roth. I actually had one client do a recharacterization where they took a Roth, they funded their Roth IRA, and then they moved it back to their traditional. And I asked them why, and they said their accountant advised them to do it, and with the intention of reducing their existing tax bill in 2020. I'm not sure if I 100% agreed with that strategy, because I think letting your money grow and then being able to take it out without taxes over the long term can be pretty powerful. But everyone's situation is unique. The next slide, please, Ryan. Does anyone have any questions at this point, or have anything come up? Okay.
Yeah. So I guess, yeah, we'll look at questions here. Someone had a question on the tax rules and stuff like that. And you mentioned how tax rules aren't taking effect just now and stuff like that, and they're still even being discussed in Congress. At what point, if something were to be passed here in this session of Congress, at what point would we expect the changes to actually take effect? Is there usually like a couple year period in which case they're in flux, or when does that usually actually happen?
Yeah, that's a good question. I would say most likely things won't take effect until January 1st, 2022. For corporate taxes, for individual ordinary income taxes, there is a chance that the capital gains and dividend unearned income could be enacted as retroactively to September 13th of this year. When Biden first announced this, there was some thought that it could be back in April, May time period. But I think that's kind of unpopular. I think it's unlikely, but it could happen. The state exemption, I think that when earliest would be in 2022. So for people, high net worth individuals, it may be advantageous to take advantage of doing some gifting. Ryan, I know you've had some calls with estate planning attorneys. That's more appropriate conversation with them. I've talked a lot about this Roth conversion, and the government actually likes it when individuals convert from traditional IRAs into Roth IRAs, because it is a taxable event and government's able to receive tax revenue from that happening. Now, there is some discussion about limiting the ability of wealthier individuals, people that have assets above a certain level. I don't know what that is. There's definitely an effort to go after taxing wealth, but from what I've read is that it would not, it'd be at least another 10 years until high net worth or high earning people would be prevented from doing Roth conversions. So it kind of encourages you to do it sooner than later, and the government likes that because it helps them with their tax collections. So I think, I think you should start to be having conversations with your accountant now if you need to recognize some capital gains this year. But I think most things will take effect at the earliest next year.
And then, okay, so next year for taxes, for the most of it, some things like capital gains might be retroactive to third quarter-ish this year, late third quarter, early fourth quarter. But looking really ahead to next year is when we would actually see those actually taking effect. And then there was a second question here on the legality of recharacterizations. It might be in terms of moving things around. You're nodding your head, so you know this more than I do on it. So do you mind going into that a little bit?
Yes. When you do a Roth conversion from a traditional retirement account to a Roth IRA, you do have the ability, they call it a recharacterization, is to reverse that transaction. So it is legal. I don't want to give wrong information about how much time you have to do that. The reasons that one would consider doing that is an inability to pay the tax. If they did too much of a conversion, they may run into that challenge. Me personally, I talked about it, what I did 13 years ago. I did a partial, I did not do a full one. And I did have, 3 years to pay that tax. I'm not 100% sure if that's still the situation today. If you would do a conversion and let's say the market falls 20%, 30%, it would make sense to recharacterize, revert it back, and then do it again at when your retirement account is a lower value. So the legality, you can do it. It's best to make sure you're talking with a CPA or someone who can keep you.
So I think as Brad's talking about is like he's just trying to make people aware of this option to them. But as always, talk to your own financial advisor on it, your tax advisor, CPA, to make sure that it is right for you and that you're doing it in the right manner, so that it is perfectly fine, that you're doing it the right way, that there's not going to be repercussions to it, but it's something to potentially bring up in an advisement meeting, especially at the end of the year as you're trying to figure things out to make sure all your accounts are in order. And then the last question here, before we continue the rest of this presentation here, is Brad had mentioned that is a tax benefit to Kendal at Home. So for those of you who are members on this call, you might be aware of already, for those that joined this year or are looking to join. As you've talked about with the sales person that you've been talking to, you may have heard of the entry fee and the monthly fees thereafter on that. The entry fee is 100% tax deductible as a prepaid medical expense. So whatever number that is for you based on your age and the plan that you're selecting, the tier you're selecting on that, that will be 100% tax deductible. And then the monthly fees range between about 60 to 65% tax deductible based on the year, also as a prepaid medical expense. So that's how that works there. The big benefit to that, as opposed to, or that is a huge benefit to Kendal at Home as opposed to other long-term care options, especially if you're paying for, say, home care out of pocket, you're not going to get that tax deduction because that's not a prepaid medical expense. So if you are interested in that, learning more about that, ask your, if you're not a member right now, ask your salesperson that you've been talking to a little bit more about that, and they would be happy to go a little bit further in depth on that to show how that might help with you. And then talk to your tax advisor to see how best to work that out. People have split it across 2 years in the past to try to get the maximum tax benefit that they can, that entry fee that is. So feel free to talk to your advisor on that as well, and with us further. So Brad, I'll just jot this back up for you. There you go.
Great, thank you, Ryan. And yeah, a lot of my discussion was, geared more toward with the Roth conversions, and now this next step is talking about, most people, they've been in the wealth and asset accumulation stage for the first 60 some years of your life, 40 some years of employment and that, and now as people age and retire, then they're in the withdrawal stage. And it's really important to be aware of the different types of investment accounts that you have, and which ones you should utilize to minimize your taxes. In the dark green upper left is taxable account. These could be your savings checking, your investment accounts. Always, again, another conversation with an estate attorney, but it's important to put things in revocable trusts. It just helps down the road with wills and estates. Now the pros of managing your taxable account is you can manage your gains and losses by selling specific assets. So you can reduce your income by taking some losses. Another positive of taxable accounts is that upon death, there is the step up in cost basis. You avoid the capital gains tax. So your beneficiaries, your heirs, benefit from that. And then the last thing is, another pro is that and this is kind of obvious, but your cost basis, you're able to spend that tax free. So if you have a big expense, $20,000, let's say, and your investment, you bought it at $18,000, it's only $20,000, you only pay the tax on that $2,000. You don't pay it on the full $20,000. Now, the negative of earning income in a taxable account is that it's the dividends and interest are taxable on an ongoing basis. The money does not grow tax free. In the upper, so in this bucket, we work with our clients in being, diversifying their assets. You would definitely want to have, tax-free municipal bonds in your taxable portion. You probably would not want to have those, tax-free investments in tax-deferred accounts or Roth account. Now with the tax-deferred account, the contributions here, you've been able to make them into your retirement account, your 401k, your IRA over the years, receiving a tax benefit, not having to pay taxes on that up to a certain income limits. That's been the benefit of being able to sock away money there. Tax deferred accounts do have, I mentioned them, RMDs, required minimum distributions, that start at age 72. This is based upon IRS tables where you need to start making withdrawals out of your tax deferred account. The government, again, they don't want you to just allow these assets to grow forever. They do want to eventually collect taxes on them. You can manage this somewhat. You're able, here's a tax planning strategy for gifting. You can make charitable contributions using your required minimum distribution to avoid taxes. And let's say your RMD is $10,000. If you gave $10,000 to the local food bank, you would avoid having to pay 30% taxes on that $10,000. Now, you're unable to recognize it as a gift, so you're not able to take a deduction for that gift, but you are able to, take it out of your income. So there are advantages to doing some qualified charitable contributions out of your tax deferred account. The negative with the tax deferred account is ones that you take directly, you're taxed on it. With the Roth, the negative with that is your contributions up front are taxed. So it's they're not, you pay the tax up front, but you get the withdrawals untaxed. You have a lot of flexibility here, because if you do have a spending need, you can take money out of your Roth and not have to pay taxes on it, so you don't impact your income. Now, with that said, you do want, ideally you want these assets to grow as long as you can, tax deferred. There are no required minimum distributions on Roths at this time. There is not talk about implementing that, which is positive. I think one of the cons of a Roth is that when it goes into your estate and it goes to your beneficiaries, they are required to withdraw over like the next 10 years. So in effect, upon your death, there are required minimum distributions for the beneficiaries of a Roth. That again is a way for the government to tax these assets. And I have a little note at the bottom, just kind of looking at where to, broadly thinking about how to diversify your assets. And granted, I mentioned earlier, municipals should be in taxable accounts. Dividend, we're big believers in using dividends to generate income. I think, high dividend investments should be in your tax deferred account, because that helps generate income and liquidity to support your RMDs, your distributions out of there. And then within Roth, you really don't need that to generate those dividends or those incomes. So you would want to have, stocks in there that you have, growth stocks, investments that you have higher expectations around their returns. Now that doesn't mean you don't want to not own, blue chip companies like, Apple or Microsoft across all three different types of accounts, but you know, you would want to be conscious and try to have more growth stocks in your Roth and more, you know, dividend yielding stocks in your tax deferred accounts. That's it on kind of talking about, you know, different income strategies to minimize your taxes. I don't know, Ryan, if there's questions there. I can talk a little bit about the investment outlook. I actually enjoy talking about this more than talking about taxes, but you know, I don't know if there's any questions out there that came up that we need to address.
No real questions on it. Someone commented on that based on 2017 Tax Act, they're saying that contributions to Roth can be characterized to a traditional IRA, but conversions cannot on that. So again, I would just talk to your tax advisor on that, especially as rules change. Tax laws are very fluid on it, and as Brad's mentioned in the past, like it seems to be changing very, very frequently on it too, and things can change year to year, especially administration to administration. So if this is something to you want to look into further with your tax professional on that. Someone commented on the entry fee deductibility to it. Yes, there are clauses for the adjustable gross income, but again, your salesperson that you've been in touch with on that can discuss that a little bit further with you, along with then talking to a CPA or a tax advisor to it as well, on seeing how this might play into effect going forward with Kendal at Home, and how you might be able to get the full benefit from that as well. So that's all I see right now. So we'll get going back. Brad, you're on the market valuation, right?
Yes. Yes. And how much more time do we have? Because I can make this.
Let's say 10 more minutes for these last few slides. Leave 10 more minutes for questions.
Perfect. That's enough. So yeah, this first slide is just shows you know, market volatility. What I tell clients, you know, investing is very emotional, right? I mean, you see things and people react to the most recent news item, especially now with their news cycle so quick. But you know, just taking a step back, I'd like to share this and just show that people you know, people that typically every year there's at least 5% correction. Typically, and we're kind of in the midst of that right now. September was first down month in the market all year. So there's at least one. There tends to be, you know, 2 5% corrections and even 1 10% correction in most years. And just looking at this, the red dots, you know, you kind of draw a line across around 10%. Yeah, there's volatility. And so what we're kind of going through right now is typical market reaction. When you look at the gray bars, that kind of shows how, you know, most years the economy grows and the stock market grows with it. So it's, you know, we're big believers in diversifying your portfolio. It's not a, you know, all or nothing scenario. So, you know, I know people may be a little nervous right now. We also counsel people, you know, if you have some spending needs within the next 6 to 12 months, you probably should make sure that they're readily available. And because if the market, you know, does correct further, you definitely don't want to be, selling at lows. We had, back, gosh, a year ago, I'd say we had maybe, 3 or 4 clients want to get out of the market in late March, early April. And, that was a painful decision, kind of giving how things have rebounded since. So this slide, I think, helps people maintain a long-term perspective and maintain discipline in their investments. On the next slide. This slide looks at the valuation of a market. If you look at the far right, it shows that the market is priced at about 20 times forward earnings. And, the market is basically, it's a pricing mechanism for the future. It discounts future expected earnings. I mean, you're buying companies today based upon what they will do in the future and not what they've done in the past. And true, we are at the top of the range, so to speak. 25-year average, markets trade around 16, 17 times. Today, we're around 20 times. Is this warranted? We think due to the low interest rate environment with, 10-year interest rates still around 1.5%, that it's worth paying up for earnings. These companies are still, yielding, earnings yields. Most of them are, between 3 and 8%. So we believe that, it makes sense to own equities at this stage. I think move to the next slide. This kind of, this shows what earnings expectations are. It's pretty incredible, honestly. Before COVID hit, the S&P 500 was expected to earn probably around $180. And as you see, third line from the left, the green line, during the year of COVID, earnings were hurt meaningfully, ended up around $120 for the S&P 500. But looking toward, this current year, expectations are close to $200. So it's pretty impressive what has happened, especially looking longer term, how the economy has gotten so efficient. I mean, technology has just been a huge game changer. It continues to be. We had many years of deflation. We're now experiencing inflation. It's a very interesting time. There is just a lot of disruption in the supply chain. It's hard to get goods, or it's becoming harder to get goods. We've all seen or read the news stories about all the cargo ships off the coast of Newport Beach, Long Beach, waiting to unload goods. It's interesting times that we're living in right now. There's over 8 million jobs available, and I think a similar amount of people who are unemployed. So it's going to take some time. As far as with COVID, I think it's been a difficult 18 months. The positives is I hopefully we're learning to live with it, and the vaccines have been wonderful. I just heard, disappointingly, I think the U.S. is still on number 43rd. We're number 43 on most vaccinated population, which is for me discouraging. But hopefully we'll get those numbers up. Between vaccinations and people who have been impacted by COVID and build up antibodies, ideally we're at getting closer to herd immunity, which should really help our economy recover. But, we'll see. we've had, the past 3 years have been tremendous for the equity markets. And I think we should count our blessings. I think yields or increases going forward will be more tempered, especially with some of the actions by the Federal Reserve of reducing their tapering. And then when will they increase interest rates? It sounds like next year around this time. But even if that happens, I mean, the economy continues to move along, and that's positive. Ryan, that's it for my comments. Oh, the disclaimer page. We can we don't have to look at that.
Fun disclaimer on it. But yeah, no. So Brad, thank you so much for going through that with us on it. It's good to hear that, especially as well, about 18 months ago with the start of the pandemic, how things kind of were all heading south at once. I mean, even looking now at where the market is, probably no one saw exactly that would rebound as well as it did. And it's good to hear that it's expected to continue growing in the positive direction for everyone as they're trying to figure out a retirement plan for the future and so forth. If anyone has questions, we tried to answer them throughout the presentation, but any more questions, please feel free to throw them in the chat. I think one takeaway that I had on this, and Brad, please feel free to chime in on it. I think one takeaway is to always kind of be prepared for the future and trying to look out and make sure that everything's that you have a plan. And that's probably the biggest takeaway, is to have that plan in place, because you don't know what's going to happen. No one has that crystal ball that's related to finances, that's related to health. So you don't know what's going to happen with the next administration. You don't know what tax laws are going to be brought in, put on the table. So to kind of have that plan that you can be flexible and move around with as you go is that great option, as Brad talked about, with the taxes changing, and to know what's ahead there. And then also with the health related wise on it, we saw it here. There's a lot of tax benefits to be taken advantage of, and so for the Kendal at home people, as it pertains to generalities, those fees are tax deductible, that 100%, and those 60 to 65% for the ongoing monthly. But for each individual, that can potentially vary. So just kind of look at that to make sure that you're working into the realm of as it pertains to you. So that's that. We have. So someone asked, what are retirement income limits on IRA to Roth conversions for singles and couples? Do you know that, Brad?
I don't believe there's a limit at this point if you're doing a conversion to a Roth. You may, it's really how much you want to be impacted by taxes. If you have $100,000, you may pay, depending on your tax rate, you may pay $30,000 of that today. So then you're starting with $70,000 in your Roth. So there is, you need to work with your accountant to kind of determine if that makes sense. When I talked about people doing partials, what some people do is maybe $10,000 a year from age 64 or whatnot through age 72. So you have 5 or 6 years to kind of migrate assets over, and a lot of that's dependent upon your marginal tax rates, which again, every individual is a little bit different with that, because depending upon what your income levels are, that extra dollar of income could impact how much you pay on taxes on Social Security income. So it's pretty complex. But
one takeaway that I had today too is that there's a lot of options out there, and tax laws vary based on individual situations. So depending on your situation, that might be a good option for you. It might not be, and to have an advisor there for you to open up your books, to have them analyze it, to look through everything, to say this is how you should go about it to get that maximum tax deduction, to set yourself up for that better financial future. Work with them in that capacity too, because these things are very tiered, progressive systems to it that can vary on an individual basis. That sound about right, Brad?
yes. I mean, everyone's situation is different. But
so one thing, and if you have further questions or comments in the chat, feel free to throw those in there. One thing I do want to highlight is upcoming events for us. So all are welcome to these events too. So if you have family members, if you have friends who you think would benefit from sitting in on these interesting topics coming up, if you want to introduce to them to Kendal at Home, please feel free to send out these invites to anyone. So this upcoming Friday, October 8th at 11 a.m., we have Up and Away, the Beauty of Ballooning, with the Seattle Ballooning Company on that. And so they're going to be talking through hot air ballooning, what that's like, and share some of the beautiful pictures and scenery that you can see from high up in a hot air balloon. So that will be a very interesting, fun event to kind of see there. Get your Friday started off right. And then on Tuesday, October 28th, also at 11 a.m., we're going to have an educational series on voting rights from 1965 to 2021 and beyond, with Professor Patrick Wolfarth, kind of going through everything there on voting rights and how that kind of shaped out from civil rights movement and beyond from there. And as always, we'd like to thank the Friends Foundation for the Aging for supporting our programming, helping us to put on these events for you all, for the general public as well, to help educate and promote healthy aging. So we got a few more things here. People, thank yous. And last question I feel here, is the Roth conversion counted as RMD?
no, it's not.
No. So yeah, good question there, as we're trying to decipher. But sounds good. I think there are no more questions on that. So Brad, thank you so much for joining us today and talking to us all about this. And looking forward to potentially having you back in the future too.
Okay, great. Thank you, Ryan.
And thank you all for joining.